Hello, welcome to the My Trail Company Investment Opportunity webinar. My name is Dmitry Kupinas. I'm the founder of My Trail Company and also co-founder of GoLite years before. For the next 30 minutes or so, we're going to go through a presentation of what My Trail Company is all about and what the investment opportunity is. So this is a picture from North Boulder of one of our favorite trails near where we live, looking south at the mountains that the Flatirons are in. And we like this picture for My Trail Company because this is really what we're all about. We're not about the usual trails and the usual views and vistas, but a different take and a different look on how the outdoors ought to be and how they should be approached and how they should be enjoyed. It's perfectly fine to have wonderful deep wilderness experiences, and those are the highlights of our life and the highlights of our year. But a trail that's near a neighborhood overlooking a wonderful set of houses is also perfectly good and an important getaway to have several times a week. We're going to go through a summary briefly and then go into a whole lot more depth on what we cover in the summary. This is what we're going to be talking about the next half an hour. My Trail Company provides Colorado investors with a unique opportunity. I, Dmitry Kupinas, co-founded GoLite, a company which achieved $17.5 million in peak annual sales. And My Trail has acquired the proven product designs and 150,000 customer email lists that GoLite developed over 16 years. So while My Trail Company is a startup, it's a startup unlike others that starts with the product designs and the customer base of a $17.5 million company. Well, GoLite did many things well, and we're going to build on those, but GoLite also did some things poorly, and My Trail will do those things quite differently, and we'll discuss them very openly later. Based on GoLite's historical performance, My Trail can be profitable its first full year by producing only the best-selling styles that GoLite made and by keeping expenses low. My Trail is raising $200,000 minimum and up to $1.4 million in this capital raise. The first $200,000 is going to go to producing only the very best-selling styles online and launching the e-com portion of our website, opening a distribution center and hiring core headquarters staff. Investments over $200,000 are going to go toward producing the best-selling styles in stores and opening and staffing small stores of about 1,200 square feet, first in Colorado's Front Range and later elsewhere in the state. Investors are going to be purchasing preferred shares in a direct public offering. Direct public offerings save money and provide investors an opportunity to ask questions directly to company management. Investment earns a 10% annual dividend. We intend to pay that in cash from the very first year. Any amount that isn't paid in cash will accrue over to the next year. And investors will receive a 20% discount on their purchases the whole time that they're invested in My Trail. The opportunity that exists is quite a large one in the outdoor industry. In this space, there are a number of companies that focus on making good high-performance quality equipment and apparel, and others that focus on making products very responsibly, and yet others that focus on making decent products affordably. And there are a few companies that do two of these things rather well, but there are no other brands that focus on all three at the same time. Focusing on all three is My Trail's differentiation. We, like GoLite, will be delivering very high performance, responsibly made products at a very affordable price. So who we are, reflective of the first picture of the North Boulder view. We're people who like to have a lot of fun outdoors and don't take ourselves or the adventures too seriously. We enjoy all seasons. We enjoy wilderness and closer to home activities. We now and then have customers and who take our products and go to K2 and Everest, and there's nothing wrong with that whatsoever, and we celebrate that too, but not to the exclusion of these more frequent, more approachable activities much closer to home. We believe in helping people enjoy the outdoors more with products that are high performance, responsibly made, and delivered affordably, as previously discussed. But there's two other very important focuses One is on lightweight, the second bullet here. In our view, high performance product has to be lightweight. If a product weighs more than it needs to, and if it is bulkier than it needs to be, then it's in the way of enjoying an outing, whether that's around the local trails or whether that's deep into wilderness. So we want everything to be as light as it possibly can be and also as compact as it possibly can be. And we think that's part and parcel of making high performance gear. Also, the last bullet point here, direct to customers, that's integral to our business model. At GoLite, for years and years, we found that we simply could not merchandise the whole product line properly through wholesaling to others. We couldn't present the whole line synergistically, and so many of the products work so well together. So it's very important to put them all together in one place, and that can only be done in our own website and our own retail spaces. And also, that goes hand in hand with delivering products affordably. By controlling our costs, keeping them way down, by having all of our own staff trained deeply in our own product line through and through, we're able to deliver fantastic product and a good customer experience at a very affordable price. Our brand is dead center in the upper half of this picture, and it's an M, a T, and a C for My Trail Company. The M is indicative and inspired by mountains. The T shows the trail that is not necessarily going over the tops of the mountains. The saddle is a perfectly acceptable place to go, and it also is symbolic of forward and upward progress. And the C doesn't just stand for company, it also very much stands for Colorado. And when we write out My Trail Co., the CO is very much hearkening to Colorado, our home state. The whole symbol here comes very much from the Continental Divide Trail sign marker below it, but also from some of our other favorite trail signs. And we like the way it evokes to us the feeling that this is a familiar symbol that we've seen a close relative of on many great trails over our lifetimes. We also like the way it applies to product. So here on what was called the Tumalo jacket, you see the symbol alone embroidered on the left chest. This symbol will work quite well on its own, as well as in certain applications with the word mark My Trail Co. The brand essence of My Trail Company is everything you need and nothing you don't. And we've spelled that out all alone on this slide because it is so vital to what this brand is all about. GoLite had the same thought at its core. And frankly, whenever GoLite strayed far away from it, GoLite got into trouble. When there were 38 packs in the line, they were all on top of each other, and while individual ones were symbolic of the brand, light and functional, the whole combination of 38 packs wasn't a light, functional, everything you need, nothing you don't product line, and it confused everybody. When we cut that product line to 9 packs, 3 very different designs, each in 3 very different sizes, it completely changed everything. The sales doubled the very next year because people understood it, because the whole product line, like the best of the products themselves, was everything you need, nothing you don't. Similarly, and we'll go into more detail on this later, when stores were far larger than they needed to be, they got messy. They invited us to produce a lot of products that people weren't really asking for to fill in those floors that were oversized. The rents were way too high. The staff costs were way too high because we needed a couple people even on a quiet day just because the stores are so large. Again, getting away from everything you need and nothing you don't is where we got into trouble. And so this is a real touchstone at My Trail Company. We're going to come back to this phrase over and over and over to have a final filter in decision making to say, is this truly everything we need, or is there a whole lot of excess here that isn't needed? Not on this product, not in this product line, not in this business process, not in the way we conduct meetings or presentations, and certainly not in the size of stores. The positioning of the My Trail brand is not about epic, really gnarly adventures. If people want to do crazy things with our products, and Lord knows I probably will from time to time, that's perfectly fine. But that's not what's central. What's central is going out and having a good time, connecting with the outdoors, ideally in nature if possible, but even a walk around a local neighborhood several times a week is better than nothing. And we want to celebrate any kind of physical activity and any kind of getting outside and having fun. Well, this is all good and well, but much of what I have just run over isn't all that different from GoLite. And that's as it should be, because GoLite did many things well. But what GoLite did poorly, MyTrail will do differently, and we're going to highlight right here and now the most important elements of what GoLite didn't do well, and MyTrail will do very differently. And we'll go into more depth on a couple of them in the next few slides. So first, physical store size was large at GoLite, and because of that, the cost was high. The rents, but also taxes, triple nets, everything associated with a store's direct costs, and also the indirect costs, the staff. As mentioned, on a quiet Wednesday morning, you still have to have a few people in a very large store, where one person would do in a smaller store. Well, MyTrail will only have small stores that have much lower costs, and we'll go into much more depth on that a couple slides from now. GoLite had a broad and unprofitable, purely casual product line. MyTrail only plans to have trail commemorative cotton t-shirts as its casual product line. T-shirts that celebrate some of our favorite trails, be they something as exotic as the Colorado Trail or the Continental Divide Trail, or as close to home as Boulder's Mesa Trail. Margins at GoLite were low, mostly because of the physical store sizes and the very large product lines. But at MyTrail, our margins will be much higher. The headquarters cost at GoLite was high. At MyTrail, it will be much lower. Part of that is because we already have all of our product designs for 5 years. We will definitely change colors season to season. We'll definitely continue to refine the fit and finish and to evolve the products, but we start with a full product line, and therefore we don't have to have a large design and development team working on that. Similarly, our IT systems are being run outside by someone who we've been working closely with for years and know and trust well, and we don't have to have large expenses there. Our marketing will be highly streamlined, and there isn't great expense there. So all of our headquarters costs will be much, much lower at MyTrail than they were at GoLite. The product line and the systems were all designed for wholesale at GoLite, and that's because GoLite was a wholesaler from 1998 through 2011. At the end of 2011, we switched over to be a retail company, and we made the move to retail with a product line that had been designed for wholesale. So certain products weren't in the line because they were the perfect thing for an individual, but because you have to show a certain variety to a buyer to get them to buy something, and then a buyer at a different shop in a different part of town buys something else. It's a very different mentality than actually saying, here is the perfect irreducible minimum of product that really serves our customers very, very well, that we'll present all of on our website and in our stores. Similarly, the headquarters team experience at GoLite was all wholesale. We had hired everybody for wholesale from the start all the way through 2011, and when we made the switch over to retail, we did so with a team that was deep on wholesale experience and knowledge and insight, but very light on retail knowledge. Our culture at GoLite was divided largely because of this tension between the wholesale and the retail. At MyTrail, it will be united because we're starting with a focus on retail right from the beginning. Decision making was reactive at GoLite for similar reasons. At MyTrail, it's proactive and metrics based. GoLite never had a board of directors and never had outside investment, and that made decision making very insular. MyTrail has a very good board of directors and is taking and has taken outside investment, and that has a good tempering, maturing effect on decision making. GoLite's brand was owned by Timberland, which in turn was owned by VF Corporation. In 2006, a deal was struck with Timberland so that Timberland could make GoLite footwear, They lost interest in that project a year and a half in and weren't the strategic partners that GoLite was looking for. And then to add insult to injury, in 2011, Timberland was bought by VF Corporation. And that led to the very unpleasant situation of having our largest competitor in the world owned by the same company that owned our brand. Well, MyTrail certainly has learned from that experience, and MyTrail owns its own brand, and it always will. So to go into more depth on the most important two factors of them all, first is that MyTrail will have a focused and profitable product line. If you look at this chart over on the left, there's three very different types of product that GoLite made: equipment, technical apparel, and casual apparel. The equipment was profitable. It turned very quickly, meaning that when product arrived, it would tend to sell out in some cases in weeks, in many cases in a few months. Discounts, therefore, were lower. Very few things had to be cleared at the end of a season, and the cash flow impact then was great. Technical apparel was also solidly profitable. It didn't turn as fast as equipment, but it turned fairly rapidly. Most products sold out completely in the season that they were brought in. It didn't have to be discounted. A few things would be discounted somewhat at the end of the season, and the cash flow impact was good. The large casual apparel line was quite the opposite. It was unprofitable. It sold very slowly. Basically, we made a lot of decent products, but that people weren't really asking for and weren't looking for from GoLite. And so it didn't sell in season. It had to be discounted very highly toward the end of the season, and the cash flow impact was disastrous. I say bad on the slide, but disastrous because it was bad enough that it got in the way of bringing in technical apparel and equipment in 2014. So that by the middle of 2014, we were in the position where, because of the bad cash flow impact of the casual apparel, we had precisely the product that people were not looking for from GoLite on the floors. We had floors full of casual apparel and couldn't bring in the technical apparel and the equipment that everybody was looking for. So it doesn't take a genius to know what to do with this experience. MyTrail will be making equipment. MyTrail will be making technical apparel. MyTrail will not be making a broad casual apparel line. We will just make cotton t-shirts commemorative of our favorite trails. Also, within the categories of equipment and technical apparel, we'll only be focused at first on making our very best-selling styles that sell out completely each season online only. And then over time, we add just the next set of styles and the next set of styles that sell next best and merchandise well together, appropriate for the sales levels we're achieving, the profitability we're achieving, and the number of stores that we may be opening. The other factor that is so important to highlight is the size of stores and the fact that MyTrail will only be opening small, inexpensive, profitable stores. If you look on the left on this slide, you see all the stores that GoLite had open year-round in 2013. 2013 because that was our peak sales year, $17.5 million. And we were not particularly inventory constrained. We had pretty much the whole product line represented. In 2014, some stores had already closed by mid-year, and there were product dislocations. So this is the best year to look at to really see what was going on. And you see all the stores are arranged from the highest selling to the lowest selling. So in the second column, you see that the website was selling $4.4 million in 2013. The Boulder flagship store sold $2.3 million, Silverthorne $1.3 million, on down to, at the bottom, Santa Fe, New Mexico, $395,000. In the next column, you can see which stores were profitable. The website was solidly profitable, so was the flagship, so was the Silverthorne store. The only other two stores that were profitable were Fort Collins and Denver, even though they're well down the list in terms of sales. Fort Collins, middle of the road, and Denver is actually below the average, and yet these two stores were also solidly profitable. Why? Well, you see the reason in the next column. This is the size of each of these stores, ranging from 4,170 square feet for Cabazon, California, down to Denver, Colorado at 1,150 square feet. So the top 3 stores were profitable because of their sales, but Fort Collins and Denver were profitable because their cost structures were so low. They cost so little in rent and so much less in heating and utilities and triple net expenses and taxes and in staff. And even though the staffs cost a lot less, the quality of the staffs was excellent. Same top quality folks, just fewer of them staffing a smaller store. And one good store manager, even on a Saturday, could take care of 3 customers very well in such a small space. And we saw that regularly in Denver and also in Fort Collins. Whereas in Cabazon, it would take 2 people to handle 2 customers on a quiet Wednesday morning. In the next column, you can see a very, very important analysis, and that is that if all of these stores were 1,200 square feet instead of the size that they were, every single one of them would have been profitable except for the bottom 3, Lehigh, Anthem, and Santa Fe. And in the last column, you can see that if there were no casual apparel line that was unprofitable, dragging down the profitability of stores, even those last 3, Lehigh, Anthem, and Santa Fe, would have been profitable as well. So, since all of GoLite stores would have been profitable if they were the size of our smallest store, My Trail is targeting 1,200 square feet for all of our stores, even Boulder, Colorado. Here's the expected timeline for some of the important milestones and activities that we'll be pursuing the next 5 years. This year, 2015, we're completely focused on raising capital. As soon as we get to $200,000, we'll be ordering 11 styles that sell best on the web. As we raise the $200,000 after that, we'd be ordering styles that sell best in stores too. We're engaging our 150,000 customers through email and social media outreach. Next year, we will finish raising capital. We'll hire a core headquarters team and sell our first products, pay our first dividends, and achieve profitability our very first year of selling products. The products that will come in the spring, we're targeting the very best selling of our packs, shelters, storm shells, and accessories. And in the fall, we would add down jackets and base layers. In the fall, we would open 2 small profitable front range stores, likely Boulder and either Denver, Fort Collins, or Colorado Springs at first. In the spring, we will have opened our headquarters / distribution center and launched our e-com website. In 2017, with profitability in 2016, we will be able to transition to lower interest inventory financing. The products that will come in would include some of our best wind shells, running and hiking tops and bottoms, trail graphic t-shirts, mid layers, and apparel accessories. And then the plan from 2017 on, we'd be opening 4 stores, small, profitable, and front range of Colorado only in 2017. And then after 2017, it would branch out to include other parts of Colorado. And after 10 to 12 stores in Colorado, then and only then, would we start to have stores in other states, likely Washington, Oregon, California, as well as some mountain states adjacent to Colorado. And we would be opening those stores not on a rigid timetable, but with the thought that so long as we maintain good, solid profitability and growing profitability, and all the stores are working and the model is consistently working, then we would continue to open in a methodical way, 2 in the spring, 2 in the fall. From 2018 through 2020, we'd be able to pay off our line of credit completely. We would start to buy back preferred shares from any who wish to sell them back to the company. We'd be introducing other key product lines that would now be able to sell out completely without excessive discounting in the number of stores that we would have. That includes ski wear, synthetic insulated jackets, tights, travel tops and bottoms, hydration and bottle packs, travel packs, sleeping bags, and stuff sacks. After 5 years, 2021 and beyond, we'd continue paying dividends and buying back shares depending on whether an investor wanted to hold their shares or sell them back to the company. We would also look to expand into product lines that are immediately adjacent to the products that we're already making, but only to the extent that our customers were asking for these product groups, and our research showed that we could do a very sound, methodical, responsible introduction of product and prove out for very low investment that it's going to be well received. These could include footwear and a children's collection as two obvious possibilities. And at some point, we would expand beyond the West, though that's a good decade off before we think we'd be going to the Midwest, the Southeast, and the Northeast with stores. On this slide, you can see the income projection that we have under the minimum investment. Once we've raised $200,000, we'll be able to order our first season's products. And if we were never to take any more investment beyond that, we would still have a solid, profitable model. And here's what it looks like. Revenue the very first year, 2016, would be $1 million, and it would grow from there about $500,000 a year. Now, even in the fifth year, 2020, at $3 million, that's only 2/3 of the $4.5 million that GoLite sold on the web. These sales would include only the very best-selling products that sell out completely online, and therefore there wouldn't be a lot of discounting. GoLite only achieved 39% gross profit. And on the line labeled gross profit, you can see that that is 55%, $550,000 in the first year on $1 million in sales. Sales and marketing expenses would grow with sales and with the product line, not just with time. And so while they do grow, they are in keeping with the level of revenues that are being generated. Same with operating expenses, such that the next highlighted line, earnings before interest, taxes, depreciation, and amortization, EBITDA, would be more than 15% positive in 2016. Right off the bat, we believe that we can achieve EBITDA of $153,000 on $1 million of sales. And that would grow slightly faster than sales, such that in 2020, we would have $628,000 positive on $3 million in sales. After modest lines of interest and decent lines of taxes, you see the net income of the company after $120,000 invested this year, $138,000 positive in 2016 and growing to $384,000 positive in 2020. You see the dividend line of payment with $7,000 in 2016 and $20,000 annually thereafter. This is 10% all the way through. This is the full payment. The reason that it's only $7,000 in 2016 is not because it's not 10%, it is. It's because it is only on a partial year, as investments are coming in toward the end of the year, and they'll be prorated for the first year and then be earning a full 10% for a full year after that. Now, it's important to note that this model does not include gift cards or wholesale or international distributor sales, all of which we do expect to do some of, but without incurring a great cost. For instance, wholesale, any dealer that wants to carry our line and sell at our prices will happily supply. We just won't go and see them at trade shows. We won't buy them dinner. We won't send them sales reps to woo them and write up orders with them. We'll avoid all of those typical expenses so that we can make a decent return on a very affordably priced, high-quality product line. Also, profitability would be able to fund stores at the end of this period. So with the retained earnings that you see on the bottom line, $12,000 in 2016 growing to over $1 million in 2020, well, that's plenty to then start building out 2 stores each season, spring and fall, as is the plan right off the bat in the more fully capital-intensive model that I'll show next. So if we are able to raise much more than $200,000, then we will be tracking toward the maximum investment scenario. So in this model, we raise $1.4 million. It's perfectly fine if it takes more than a year to raise it. because it isn't all needed up front. In this scenario, web sales are somewhat higher than in the previous. You see the top line, web sales starting at $1.275 million in 2016 and growing to $4.5 million in 2020. Even in that fifth year, that's only the same amount that GoLite was selling on its web. And the reason why the web sales is higher here is mostly to do with a larger product line. Opening stores, we will have a much larger product line. Now, those products that are added are specifically ones that sell better in stores than on the web, but they do sell on the web, and so they will have an incremental effect on the web. There is another dynamic, though, that drives web sales up when you are operating physical stores, and that is that we collect a lot more customers. We collect a lot more emails every day, and that builds the list that then buys from the web. If a store runs out of something, then people can buy it from the web. The best dynamic is when a visitor from out of state or out of country comes into a store. They're exposed to the brand. They see what's going on. They like what they see. But then when they go back home, they don't have a store to buy from, but they're still able to buy from the web. The next line, you see the revenue from stores. It would only start at $408,000 in 2016 because that's just 2 stores open for just the last 3 months of the year. But as we add a couple of stores in each spring and each fall, it builds to 18 stores by the end of the 5-year period. And those are driving very significant sales that are several times as large as the web alone. The overall revenue line here, getting to $18.3 million in 2020, is only a little higher in year 5 than what GoLite had already achieved. You can see at the very bottom, by the way, the number of new stores opened each year, 2 and then 4 each year after 2016, the physical store count at the end of each year. You also see the average number of stores, and that average is a weighted average for the level of sales that a store achieves in any given month. And then finally on the last line, you see the average sales per store that's open a full year, starting with $600,000 in 2016 and then going up by $60,000 each year. That increase of $60,000 is completely accounted for in the expansion of the product line. So by having each next tier of product that sells out first in 2 stores in a web, then in 6 stores in a web, then in 10 stores in a web, and so on, it adds solidly to the level of sales in each store each year. Now going back up to the gross profit line, we've put 55% in there again. The types of products that sell better in stores than on the web actually demand a higher price and a greater profit margin. But there also then is more discounting at the end of a season. And so keeping the same 55% is appropriate. We would start our margins over 60%. We would figure on very, very little discounting because, again, these are only the proven products that we'd be bringing out. But there would be a decent amount of discounting to all of our investors who will get 20% off every day. And occasionally there'd be some discounting as we send something to an international distributor or to a group purchase for a guide service or a river rafting operation and so on. Sales and marketing and operating expenses are going to be kept very, very tight. You can see them growing significantly, but in each case their growth is driven by sales and profitability, and not the other way around, and certainly not the passage of time, such that the earnings before interest, taxes, depreciation, amortization starts positive the very first year of selling, 2016, and grows much higher than it does in the lower investment $200,000 capital raise model. So that by the 5th year, 2020, we have EBITDA of near $3 million. There's a very low interest line again and a much higher taxes line, resulting in a net income line that you see starts at $35,000 in 2016 and grows to $1.8 million in the 5th year. Dividends paid would be much higher, with $140,000 each year, 2018, 2019, 2020. As with the previous slide, it's 10% right from the very first year, 2016. But we wouldn't have $1.4 million in hand by the end of 2016. And even though we intend to by the end of 2017, it will not have been in hand for the entire year. So there is a partial payment on those years. The retained earnings line, the next one, is starts out with $120,000 loss / investment this year that we're not selling products. And then that retained earning line gets better every year as we have positive net income even after dividends. And by the end of the period, we would have more than $3 million in retained earnings in 2020. And we would just continue to continue this pattern of paying dividends and expanding stores methodically. We don't plan any radical changes. It's possible we might franchise to responsibly and carefully and conservatively expand at a more accelerated pace. But we really want to take the long-term view, establish a pattern that really works, and then continue that pattern forward. So exactly what is the deal? It's all laid out here. There's, of course, fine print in the offering documents, and some of that is referred to in the very last bullet on this page. But here's all of the essential important stuff. What we're doing is a direct public offering, a DPO. This is like an IPO, an initial public offering, except that instead of a company selling its shares to an underwriter, who then marks up the price and sells to the public at a higher price, we're selling the shares directly to the public. So the public is getting much better value, and so is the company, because everything invested comes straight in. We're offering $280,000 of 280,000 shares of non-voting, non-convertible preferred stock at $5 per share. This offering is only available to Colorado residents for the simple reason that we have only registered to raise capital here in Colorado. Colorado has great regulations and a great environment in which to raise capital. Plenty of other states do too. But all the regulations are different in different states, and so one has to file and register in each of them that one wants to raise in, and it just made a whole lot of sense for us to focus on our home state where we have so many great customers. The minimum investment is 200 shares for $1,000, and if an investor is accredited, then the minimum jumps to 1,000 shares for $5,000. Dividends will be paid. The annual dividend is 10%, and any amount that isn't paid out, though we intend from the start to pay it out, all that out in cash, any amount that wasn't paid out would be accrued over into the following year. There is a buyback provision if an investor wants to sell shares back to MyTrail after 5 years. They can do so. They can just notify the company that they want to sell back, and the company then has to purchase those shares back for the full price that they were sold for. After 10 years, MyTrail has the right to buy shares back from the investor. So if the company wants the shares back at any time before 10 years, it can also exercise the right to do that, but it has to pay the full price that would be due at year 10. So for instance, if after 1 year, for some reason, MyTrail wanted to buy all these investments back, that's fine, but it would have to pay the full 10 years times 10 dividends to the investors, in addition to the original purchase price, doubling the money that the investor put in, though less whatever had been paid out in dividends in the meantime. There are certain transfer restrictions. The state of Colorado won't allow shares to be sold outside the state for 9 months, for instance. But really, the anticipation is that if these shares are ever sold, they're going to be sold back to the company, because there's a very clear value marked on them, and it's not a free-floating valuation that would be done on an open market. The mechanics are fairly straightforward. The first step is that an investor reviews the disclosure documents, which are labeled Form RL, Colorado's term for a prospectus, and all that's available on our DPO site, dpo.mytrailco.com. And an investor can then ask any questions of MyTrail company management, either through emails, telephone calls, a variety of different forms. After that, an investor and MyTrail company sign a subscription agreement. Then the investor sends funds in. Those funds go to KeyBank, and they're held at KeyBank until MyTrail company reaches the $200,000 minimum required to produce our first season's product. So essentially, they're in escrow there at KeyBank until we get to $200,000. Dividends are calculated from the date that funds are received at KeyBank. So it is in the interest of investors to invest as soon as possible. It's also in the interest of MyTrail because the more we can raise the earlier, the more other investors see that and also jump in. Finally, once the minimum amount is raised, MyTrail will issue shares, and then any amounts that come in after that, MyTrail issues those shares immediately. Now, we believe that we will be able to get to the $200,000 minimum. If for any reason we're not able to achieve the minimum in the 12-month period that we are allowed by the state, then investors will receive their investment back automatically from KeyBank, and they will also get the bank interest that has accumulated at KeyBank. So there really isn't any risk. So all of this is to a singular grand purpose that we have, and that is to take some of our very best customers who have really enjoyed the products that we'll be making over the years and want to take one more step and not just be fans and customers, friends and evangelists, but really be investors. And by being investors, people will end up making MyTrail company their trail company. Thank you very much for your attention to this webinar, and we hope very much to hear from you soon and that you'll invest in MyTrail. Take care.